Apple spent $755 billion buying its own stock. Not on factories, not on new products, on its own shares. If you own Apple or you own an S&P 500 index fund, you already paid for that trade. Today, I'm going to show you exactly how to tell if it helped you or quietly hurt you. My name is Pablo, and this is the Research Desk, where every claim is cited, every strategy includes its failure conditions, and there's zero hype. If you're new here, welcome. If you've been here before, let's get into it. Here's the basic math. Earnings per share is earnings divided by shares outstanding. A buyback reduces the denominator. Shares outstanding goes down, earnings per share goes up, even if actual earnings did not change at all. That is why buybacks are so powerful, and that is why they can mislead you. In 2024, S&P 500 companies spent $942.5 billion on buybacks, a record total. Over the 10 years ending September 2025, Apple alone spent $755 billion buying back its own stock. That's not a typo. So the question is not, do buybacks matter? They are one of the largest uses of cash in corporate America right now. The question is, how do you tell if a specific buyback is returning real value to you as a shareholder, or if it's wasting cash, covering dilution, or buying at the top? For that, use 4 letters, C.A.S.H. C stands for cash source. Here's how. Ask one question. Is this buyback funded by real free cash flow, or is the company taking on new debt to pay for it? A healthy buyback comes from cash the business actually generated. Cash left after operations and after reinvesting in the business. That is, shareholder money being returned calmly. A risky buyback is debt funded. The company borrows money to buy its own shares. You now have leverage risk on top of the share purchase. If business slows, you still have the debt payments, but you already spent the cash on the buyback. You added risk without adding earnings power. Failure condition for this step: if you see long-term debt rising year over year while the buyback accelerates, that is not efficiency, that is financial engineering. Save this check. It runs before any of the others matter. A stands for actual float shrinking. Here's one most beginners miss. Companies do 2 things at once. They buy back shares and they issue new shares to employees as stock compensation. You have to check if total shares outstanding are really falling year over year. Many buybacks only offset that new dilution. The company announces $10 billion in buybacks, but shares outstanding barely moves at all. You got a headline, not a smaller denominator. Here's the flip side of that trade. When the float truly shrinks, the math is quiet but powerful. Over the 10 years ending September 2025, Apple's share count fell dramatically because of that $755 billion in buybacks. A shareholder who never bought a single new share still ends up owning a larger and larger slice of Apple over time, purely because the total number of slices keeps shrinking. So the check is simple. Who loves shares outstanding year over year for the last 3 to 5 years? Is it actually down? By how much? If the float is flat while buybacks are large, the buyback is paying employees, not you. Before we keep going, if this is giving you an edge today, smash that like and subscribe button for weekly market research. It's free every week. And tell me in the comments, which of these cash checks are you running first on your largest holding? S stands for share price paid. This is where good buybacks become great ones, and bad buybacks quietly wipe out value. Buying back stock at a cheap valuation rewards remaining shareholders. You retire shares when they were cheap. Each remaining share now owns more of the future earnings for a great price. Buying back stock at an expensive valuation, just because cash is sitting around, can quietly destroy value. You spent real cash to retire overpriced shares. You could have paid a dividend, paid down debt, or just held the cash. Right now, that matters more than usual. The overall market in 2025 hasn't been this expensive since the dot-com era on some valuation measures. That does not mean every buyback today is bad. It means the hurdle is higher. Management has to have a real valuation discipline. The failure condition for this: If a company is buying back aggressively at all-time high valuations without mentioning price or value in their earnings call, they are not allocating their spending. H stands for history of follow-through. A buyback authorization is not a promise the way a dividend is. Companies can pause it anytime, no explanation owed. They can announce a larger number for the headline, then spend only a fraction of it. So check whether past authorizations were actually completed. Look back. When the company announced a $20 billion or $50 billion authorization last year or 2 years ago, how much did they actually spend? Is there a pattern of announcing big and buying small, or do they quietly execute quarter after quarter? Apple is the example of follow-through. Authorization after authorization, year after year. The cash was actually spent. $755 billion over a decade is not a headline, it's a track record. Some companies do the opposite. Big headline, small execution. That tells you the announcement was for sentiment, not for shareholders. And remember, even reliable programs can be paused in a recession or cash crunch. That is the failure condition of every buyback. Do not count future buybacks as guaranteed cash in your model. Only count what was actually retired. So let's put cash together. Before you celebrate a buyback headline, run these 4 questions in order. C. Cash source. Is this free cash flow, not new debt? A. Actual flow. Are shares outstanding really down year over year? S. Share price. Is management buying at a reasonable valuation? H. History. Did they actually complete the last authorization? If a buyback passes all 4, it is likely adding value per share. Fewer shares, but with real cash at a good price by a team that follows through, that is compounding in your favor. If it fails even one, especially C or A, treat the headline as noise until the numbers prove otherwise. Picture this, next earnings season, you see Company X announces $10 billion buyback. Instead of guessing, you open the filing, check those 4 letters in 60 seconds, and you know whether to model a higher EPS or ignore the headline completely. That's not noise, that's a process. That is your cash checklist for any buyback announcement. Save this video, the checks don't change. Tell me in the comments, which of these 4 are you watching for more closely right now? C, A, S, or H? Until next time, trade smart, stay curious, and keep your emotions out of your portfolio. Thanks for watching, guys.